So we'll commence the discussion on the mock paper for advanced corporate reporting paper, the strategic level. First, we'll go through mm, the instructions. In this paper, there are two sections. Section 1, there is a question, 50 marks. That's a compulsory question. Then section B, there are three questions. Out of that, three you should answer for two. 25 marks each. So altogether, section A and section B, 100 marks. Right. So you can see the booklets that you are allowed to bring to the examination hall. This is open book examination, particularly the newly adopted standards on sustainability are SLFRS S1 and SLFRS S2. Currently, these two standards, compulsory to adopt by companies or PLCs, public listed companies, top 100 public listed companies in terms of market capitalization from 1st of January 2025. Now they released first report with the adoption of SLFRS S1 and S2. Now when you go to financial statements uploaded to the Colombo Stock Exchange, you can see the disclosures on SLFRS S1 and SLFRS S2. My recommendation or my advice for you to read at least couple of annual reports and see how they have disclosed on SLFRS S1 and S2, right? That is my advice. So there is a high potential, high probability, testing from either SLFRS S1 or SLFRS S2. So this paper I incorporated SLFRS S2, right? S2, climate change. Okay, when I said this mock paper, okay, there is a high probability, right? I'm not going to take much time. The major points that I wanted to highlight we'll discuss in detail, but uh, I will provide detailed answer script, right? I will provide it. Once I complete this particular discussion, I will be releasing the suggested solution document. So you can go through it. Okay. I know some of you answered. I got to know that around 30 people answered, by participating in CA Sri Lanka, but there are around 76 people joined today. So they joined, the majority, they joined to just listen and, get some understanding, get some insight for the upcoming examination. Remember, these are mock papers. You are now I align this particular paper when I set the paper, I align with the model paper developed by CA Sri Lanka on new curriculum committee. So I align with that particular paper, right? So there are new set of questions, new standards, in sense SLFRS S2, the mock paper, sorry, the model paper, there was a question on SLFRS S1, but here when I said the paper, SLFRS S2, right? In addition to that, when I set the paper, I selected different accounting standards like SLFRS 8, operating segment, LKS 24. Uh, that's on related party transactions. Now, this is strategic level, no? Strategic level. In strategic level, the less calculation. So you need to give some advices, maybe to the board level, right? So when you see the action verbs, you could realize that there are few calculations as well, but the perception of the uh, requirement would be different in the strategic level, right? In corporate level, there are many calculations, consolidated financial statement with associate joint ventures. I hope you can remember the full consolidation is there, the disposal of subsidiaries. And there are many calculations. Okay, but here in this paper, less calculations compared to uh, corporate level, right? Compared to corporate level. So I hope you realize that. Uh, right. And other thing, your original paper may be different. Maybe different because the paper setters different, right? The discussion, why we are having such discussions, for you to give some comfort, right? As students, as CA students, your responsibility is to cover the syllabus. Cover the syllabus. Examiner, independent examiner will set the paper from the syllabus. But he or she cannot test by covering all the standards. No, right? Therefore, predicting accounting standards and preparing for the examination, there is a risk for our profession. Therefore, you should cover entire syllabus, and you have in strategic level, you have to have overall understanding, holistic view, right? When you answer these are kind of a case study type. Now, when it comes to question number one, that's a kind of a case study. Small case study, not a big case study that you will be writing in future. So there is a case study as well, no? Not like that, but the nature is that, right? Okay. I wanted to tell that particular message in the beginning. As chartered accountants, future chartered accountants, you have to have holistic understanding about the business environment, legal environment, compliance. So you have to have that overall understanding, right? Now, what we can do is we'll start with question number one. I know we don't have enough time now. Now, this is even writing time 3 hours. Writing time 3 hours, but we'll discuss important areas, right? The pure purpose of this discussion is to give some comfort for your examination. Maybe there can be similar questions, maybe not. Sometimes in the real question paper, in the main question paper, there are no any similar question. There can be, right? Okay. So don't worry about it. But here you will be getting some guidance, advices, how you could face for the examination, right? Now let me read question number one. I have my whiteboard. Here you can see my whiteboard. So I will write in my whiteboard. Then you can write in your writing book, right? Okay. First, we'll read first question. That is a compulsory question. This question was set. So there are different parts, right? Yeah, there are 50 marks, no? Different parts. The first part connected with SLFRS S2. Now, basically, there are two standards already adopted by CA Sri Lanka, being the authorized institute from the number 15 of 1995 Accounting and Auditing Standards Act. CA Sri Lanka has power to issue accounting standards for our country. That legislation or the parliament has given that particular power to Sri Lanka. So you are going to be members of that prestige institute very soon. Very soon. Right. Let me read first question. Before that, we'll read the requirements. Requirements. So that's another strategy that you can use before reading the body of the question. First, you should be aware what are the requirements, right? Without reading the requirements, if we are reading, then that absorption would be limited, right? Therefore, my advice, you should read the requirement first, right? See, required. Part A. Evaluate the application of SLFRS S2 climate-related disclosures and SLFRS S1 general requirements for disclosure of sustainability-related financial information to the climate transactions program. Climate transaction program. At the same time, I would like to say now already SLFRS S1 and S2 already issued by IASB. And we have adopted as a country, as a member country, we have adopted SLFRS S1 and S2. There is another standard coming in, not yet adopted, that is SLFRS S3, that is biodiversity. Biodiversity, right? So has paper shared in the screen? I cannot see. Is that so? I have shared. Hi students, can't you see the screen? I have shared it. Mahesh said can see, can. Right, can. The person who said you cannot see, please change the screen and see, yeah? Right, okay. Right. Now, section A, evaluate. Look at the action verb. Action verb, evaluate. That's a high order level action verb based on the Bloom's taxonomy. Bloom's taxonomy, high order level 1. So you can earn 10 marks. Your answer should include assessment of materiality, climate related risk and opportunities, then connected information between sustainability disclosures and financial statements, and disclosures relevant to primary users of general purpose financial report. Now, disclosures can be done, but there should be connected information. Now, for an instance, there are some, expected projects for the future. So when it comes to budgeting, we have to have, we could see the budget allocation, right? Budget allocation for such projects, right? Then we can see the connection. We can see the connection and the board level involvement on those sustainability related matters. Sometimes there are subcommittees in the main board, right? So those things can be connected. So we'll take one by one and discuss. Now let me read. Okay, before that, uh, part A on SLFRS S2 basically. S2 and S3, there are similarities. Right? So basically, the materiality, climate-related risks, then risk and opportunities, governance, targets, metrics. So there are common items in both standards, right? So therefore, when you write the answer, we need to connect both standards and articulate with the given information. Right. Second part B, the question was set on LK's 23 borrowing cost. Borrowing cost. If I brief the question, you are given specific loan as well as common loan. Specific loan and the common loan. Then specific loan, so that this organization has invested on temporary basis and earned some temporary interest income. Then there is a suspension period as well in that particular year, suspension period. So likewise, you need to answer, determine qualifying asset status, whether that is a qualifying asset or not. Then calculate the borrowing cost to be capitalized. Then treatment of suspension period and investment income. What you should do with that? You need to write. You need to write them. Okay. For that, 10 marks you can earn. Then evaluate accounting treatment for the executive share option scheme. SLFR 2 share-based payment. So there are sub-questions you can see. Explain, assess, calculate, and explain. Then part D, advise the board regarding the application of SLFR LKS 24, that is related party disclosures. Related party disclosures. Assess whether Quantum Logistics Private Limited and Solar Future Private Limited are related parties. Evaluate the required disclosures. Discuss whether disclosure exemptions are available because transactions occurred at market terms. Last one, evaluate the measurement and disclosure requirements applicable to digital infrastructure assets under SLFRS 13 fair value measurement. Fair value measurement. Identify the appropriate fair value hierarchy. There are fair value hierarchy, level 1, level 2, level 3. Then valuation approach, market approach, income approach. So likewise, there are different approaches. Then explain disclosure requirements relating to significant unobservable inputs. Level 1 input and level 2 input and level 3 input, particular level 3 unobservable. Advise whether commercial sensitivity justifies omission of disclosures. Right. So there are 5 sub-questions. For the section A of the question. Right now we'll read the common information. Okay, I will keep this. Next Gen Holding PLC is a publicly listed Sri Lankan conglomerate with operations with renewable energy, advanced manufacturing, digital technology solutions, and sustainable infrastructure development across Asia and Africa. Asia and Africa, you can underline them if you are having a paper. Asia and Africa, two different regions. The board has recently approved a strategic transformation program focused on decarbonization, innovation-led growth, and sustainable financing. The Audit, Risk and Sustainability Committee has underlined that one as well. There is a particular committee, sustainability component also embedded with the compulsory committee. Now, audit in the audit committee is compulsory. Risk committee is compulsory, but sustainability committee is not compulsory as such yet. But this particular company has incorporated sustainability for a committee. So that decision from the board. So when you read, you need to highlight and you need to write the points. Or you know the questions to be answered, right? Then while you are reading in the very first shot, you should articulate your answer. You should articulate your answer. You know what to be written. You can visualize your answer. Suppose without reading the requirement, you read in the beginning. Definitely, you need to read the question 2 times because you were not aware the answer to be written. That's why I asked you to read the question first before reading the body. Right. Audit and Risk and Sustainability Committee has requested integrated assessment of several transactions and reporting matters for the year ended 31st March 2026. Climate Transaction Program and Sustainability Linked Financing. So we'll read relevant information for the first part and try to answer. Then we can save time. Okay. NHL has publicly committed to achieving net zero greenhouse gas emission by 2045. Achieving net zero greenhouse gas emissions. Okay. By 2025. During the year of financial year 2025-6, group issued 15 billion sustainability linked bond, SLB. The bond agreement contains the following conditions: reduction scope 1 and scope 2 emissions by 30% by 2030. Can anyone tell what do you mean by scope 1 and scope 2? Can anyone tell what do you mean by scope 1 and scope 2 emissions? You can use the chat and tell what is scope 1? Scope 1 emission. Scope 1 emission means, yes, in the organization, those emissions generated, for an instance, vehicles owned by the organization. Because vehicles are controlled by the organization. So those are called scope 1. In addition to that, the scope 2 in the sense indirect involvement. For an instance, electricity board. Now, electricity board provide electricity, but the electricity board, they have some emissions. No? They have emissions. But when we use the electricity, so we are also contributing to that. We are also contributing to that. That's why we need to reduce that particular emission, scope 1 as well as scope 2 emissions by 30% by 2030. Right. Yes. Scope 1 and scope 2. Right. Very good. You have answered. Navodaya and ALF. Navodaya and ALF answered for scope 1 and scope 2. Right. Scope 1 is direct, scope 2 is indirect. Right. Okay. So you have to have some examples, practical examples. Another thing is you can apply them to your organization as well. I know you are working Maybe you are studying in universities, uh, so you can mm, apply them to your organizations as well. You can take examples from your own organization. Then you can inculcate these concepts, scope one and scope two, right? Okay. So that's a kind of a promise, right? Now they are issuing 15 billion sustainability linked bond. The bond agreement consists these agreements, these points, these promises, annual publication of climate related disclosures aligned with the international sustain reporting standards. That's another promise. And achievement of specified renewable energy generation targets. There is a target as well. Failure to achieve any target would increase the borrowing rate. That's another point. Very important point. If we are failing to achieve these requirements, borrowing rate will increase by 2%. Then there is a motivation to achieve these targets. But there is a risk. There is a risk increasing borrowing rate by 2% if they are failing to achieve these points in the agreement. So you should highlight them in your answer. Hmm. During the year, an independent climate consultant reported that one of NHL's major manufacturing facilities is located in a region projected to experience severe water scarcity and increased flooding risk within the next decade. Yeah, there is a risk. The management estimates potential climate adaptation expenditure 2.3.2 billion over next 5 years, increase infrastructure cost of approximately 120 million annually. There is a insurance cost if there is a flooding and all. So organization should be protected, or the damage they quantified and they insure to control the damage, control the loss, manage the loss. Hmm. When there is now there is a risk of flooding, no risk of flooding. Hmm. Right, insurance cost increase. Hmm. Then potential impairment indicates certain manufacturing assets if climate related regulations become more stringent. The Sustainability Committee is uncertain whether these matters require disclosures and how much information should be connected to the financial statements. Right. Okay. So those are the information that you are given for the part A. Part A. So construction of green hydrogen facility, that's for the LKS 23. Yes, that's for the 23. Now, before reading this part B in the question, we'll try to articulate answer for the part A. Okay, part A. Okay, now you understood the risks connected with uh, SLFRS S1 and S2. First, the materiality assessment. You need to do the materiality assessment. Part A, materiality assessment. Materiality assessment. Now, what do you think about materiality assessment and SLFRS 1, general requirements for disclosure of sustainability related financial information? Now, these are financial reporting standards, right? Sustainability as well as financial accounting related IFRSs are there. Sustainability related standards are there. Hmm. Okay. So first we need to see, we need to evaluate the materiality assessment. No? In material assessment, in the sense, if we miss some information, if that is influence for a decision, that is material for the primary users of financial statements. Who are the primary users of financial statements? Investors, potential investors, lenders, and other creditors, right? So those are the primary users of financial statements. Therefore, you can say uh, the materiality assessment. Hmm? Okay, so materiality assessment means sustainability related information is material if omitting, misstating, or omitting or misstating, it could be reasonably be expected to influence decisions of primary users. Do you need to uh, uh, what do you need? Do I need to give enough time to write them, or only explanation? Or do I need to write the answer in the whiteboard? Or this explanation is enough? What do you think? Writing is better. Write the answer. Whiteboard. Right. But it will take some time. But majority, some people said that, better to explain and provide the answer script different, separately. But based on the people who explanation is enough, there are mixed requests, requests. Another thing is, I think this explanation is recorded, I guess. Check whether this is recorded, this session. Record? No. Since this is recorded, I think no need to spend time for writing, right? Explanation is enough because you will be given the recording. You will be given the recording. I will explain. Then the summary can be written as the answer. But the main points I will write. Main points I will write. First, materiality assessment, right? So you should. I hope you are okay with that, right? So we'll go with the majority request, majority request. Right, okay. Materiality assessment. First, we need to write about that. Okay. So all these disclosures for the primary users, no? Primary users of financial statements. So you can write on that. Now, there are basically two main expenditure. Insurance cost is material. Insurance cost, because uh, in the description, I hope you have noted the insurance cost is there. Hmm? Uh, Now there is an agreement as well. No? Now individually maybe that is insignificant, but since there is an agreement, they have issued 15 billion sustainability linked bond. Therefore, there is a risk on increasing. If they are failing to achieve those requirements, there is a risk of increasing borrowing rate by 2%. So you could write that this way. Now, though the climate adaptation expenditure and the insurance cost increases may not individually be material, the climate related matters become material because the group has issued 15 billion sustainability linked bond, right? Failure to achieve climate targets, there is a risk to increase borrowing cost by 2%. You can write them bullet points, right? You can write them bullet points. Okay. Then there is a risk. Climate risk may affect future cash flows, financing cost, asset values, as well as business strategy. Next bullet point, you can write there is a potential impairment indicators, because you read the mini case on the climate change. There is a flooding risk next decade. So you need to connect them and write potential impairment indicators exist for manufacturing assets. Therefore, climate related risks are material to investors, lenders, and creditors. Okay, you need to highlight that part first. Material assessment, right? That's the first part. Then you can write climate related risks. Climate related risks. Climate related risks. What are the climate related risks? There are different types of risks. First one, physical risks. Physical risks. What are the physical risks? There is a water scarcity. Water scarcity in the future. Then there is a flooding risks affecting manufacturing operations. Then there is a risk of increasing insurance cost. Then potential disruption to production. Potential disruption to production. Then transition risk. Transition risk. When there is a transition, what would happen? Regulatory changes are there. No? So there is a regulatory risk. Then as per the agreement, there is a carbon reduction requirement. So that's a kind of a transition risk. In order to transition, so there are requirements. So we can show them as a risk, carbon reduction requirement risk. Additional capital expenditure for the adoption. Additional capital expenditure requirement for the adoption. Then potential financial consequences if bond targets are missed. Now there are requirements given by the agreement. If organization, failing to achieve them, there is a potential financial consequences. Right. Then we'll talk about climate related opportunities. Climate related opportunities. What are the opportunities? Access to sustainability link financing. Access to sustainability link financing. Then next one, improved reputation. Now that company would be a reputed company since they have connected with sustainability linked financing. Then next opportunity is lower long-term operating cost through decarbonization. Lower long-term operating cost through decarbonization. The next opportunity is increase investor confidence. Since they are connected with the sustainability linked financing, and there is a decarbonization strategies, then the investors' trust and the confidence can be increased, right? So those are climate related opportunities, right? Then you need to emphasize connected information. So I'm answering for the part number one. Part number one, in the hint, you are given hint. You need to include this area, connected information, opportunities, risks, likewise. So we are providing those answers. Yes, there are two physical. Yes. All these things need to be mentioned separately. Yes, you are correct. You are correct. By aligning with the mini case, now you are provided some information. You need to link with that and write the different types of risks. Right. Then connected information. Connected information. Particularly, these connected information requires SLFRS S1, Sustainability Reporting General Disclosures. Connectivity between sustainability disclosures and financial statements, right? Then, now for an instance, we can say climate adaptation expenditure. That is the sustainability matter, right? Then you can write financial statement impact. Maybe you can introduce a table like this. When you provide the answer, you can provide table like this. Here, sustainability matter. Sustainability matter. Here you can write financial statement impact. Impact. Then point by point you can write like this. Climate adaptation expenditure. That's the sustainability matter. Then financial statement impact, future capital commitments. Future capital commitments. Then sustainability matter, increase insurance cost. Then financial statement impact is forecasted expenses. When insurance cost increase, that should be reflected from the financial maybe budgets, maybe in the overall financial statements. In financial statement, yes, we can see the actual cost, no, right? That's a historical cost. But when organizations doing plans and all budgets, so if we can link forecast expenses. Then next one, bond interest step up. Bond interest. Now, we have issued bonds, no? We have issued bonds, sustainability linked bonds. Then in future, in terms of that, future finance cost, that is the financial statement impact. Future finance cost would be increased, right? Because of that. So you can write financial statement impact as future finance cost. Then next one, climate regulations. That is a sustainability matter. Climate regulations. Then financial statement impact is asset impairment assessment. Asset impairment assessment. Because assets need to be impaired based on indicators as per LKAS 36. Right? When there are climate regulations, we need to incorporate them to assess or to measure the impairment. The next sustainability matter is net zero strategy. Net zero strategy. Then financial statement impact is capital allocation disclosures. Capital allocation disclosures. CapEx, capital allocation. Why we should mention these connected information? The reason is users or the potential users or primary users, they should be able to understand how climate related matters affect financial performance and position, right? Okay, then next part that you can link with required disclosures under SLFRS 2. Required disclosures under SLFRS 2. Let me go to another page. Right. Another page. Required disclosures under SLFRS 2. That's climate change. So there can be main points, main headings. Governance. First, you could write with the governance. Under governance, you can write, you can disclose board oversight of climate risks, management responsibilities, okay? Those two things basically under governance. Then we can write under strategy. We can write climate related risks and opportunities, impact on business model and strategy, resilience of strategy, okay. Then the main sub-point is risk management. You can incorporate processes used to identify and manage climate risks. Processes used to identify and manage climate risks. So you need to disclose about them. Then next one, metrics and targets. Metrics and targets. Under metrics and targets, you can incorporate scope 1 and scope 2 emission. Scope 1 and scope 2 emissions. Climate targets. Progress towards targets. You can emphasize or you can disclose progress towards targets. Then sustainability linked bond commitments. Now you have seen the commitments, right? You can mainly write or disclose on these areas, right? Okay. So those are the things that you need to write for 10 marks. Okay. Right. That's the expected answer. expected answer. Okay. Now we'll go to next one. What is next one? Construction of green hydrogen facility. First, I can remember there was a question whether this particular asset is a qualifying asset or not. You need to decide it. LKS 23 precisely explain what is a qualifying asset. That has been defined. Did you learn LKS 23 in please don't say you have not learned. You should. You should. LKS 23 borrowing cost. Normally borrowing cost we charge to P&L, profit and loss. Normally, borrowing in the sense interest cost and related cost, no. Borrowing cost also defined in the standard. Normally we charge to P&L. That's the normal accounting treatment. However, if we obtain loans, if we obtain loans for a qualifying asset. Qualifying asset means asset which take considerable amount of time period to bring into usable or sellable condition. Usable or sellable. Usable or sellable condition. Right? Usable or sellable. What do you mean by sellable? Can you please indicate the important para number? What do you mean by that? Important para numbers in the sense, that's what I said in the beginning. When you write standard, right, okay. Now, mainly SLFRS S1 and S2, you have seen the connection. So mainly those two standards talks about governance, strategy, risk management, and metrics and targets, right? Both standards, you can see them. Then, you were asking qualifying asset example. Right. Para 7. I thought for the previous one you were asking. Right. Para 7 qualifying asset. Right. Okay. Now, what I was trying to explain here, right, I got to know that. So now you mentioned also for LKS 23, yes. Remember, the 23, that's connected with the borrowing cost. Qualifying asset means asset which take considerable amount of time to bring that particular asset into usable or sellable condition. Can I ask more question? Can we consider inventory as a qualifying asset? Can we consider inventory as a qualifying asset? One say, yes, wine production. Depending on the circumstances. Yes, in the wine production and all, now same definition. If that particular product take considerable amount of time to bring to sellable condition, that could be a qualifying asset. then if we can categorize that one as a qualifying asset, yes, that borrowing cost can be capitalized to the inventory. Otherwise, we need to charge them into P&L, finance cost. Right? So this is a standard, crucial standard. Right? So your answer is correct. We need to, now definition is important. The definitions are given by the standard to minimize the inconsistencies. Otherwise, different people would define or apply different way. That's why there are definitions from the conceptual framework for financial reporting to each and every standard. Most of the standard provide definitions in the beginning of each standard, right? Okay, now look at this information construction of green hydrogen facility, green hydrogen. 1st of April to 2025, NHL commenced construction of green hydrogen production facility expected to become operational on 30th September 2027. That is the expectation, right? That is the expectation. Yeah, when you read that one, now become operational on 30th September 2027. Remember, in the standard, there is no specific time period qualifying. In order to be a qualifying asset, the period should be more than 6 months, more than 9 months, more than 1 year, more than 2 years, nothing. Even 1 month, we can judge whether that's a qualifying asset or not, right? That's why we have to have professional accountants. So their judgment is important. Now, these standards are principle-based standards, not rule-based. These are IASB, International Accounting Standard Board. These standards are developed based on the principle, not based on the rules. But US GAAP mainly focus on rule-based, not like IFRS standards, right? Therefore, the professional accountant's judgment is very, very essential. Right. Now, in that point, the first answer that you should write is whether this is a qualifying asset or not. So we can say the green hydrogen facility requires a substantial period to prepare for use. Therefore, it is a qualifying asset under LKAS 23, right? 23, right? That is the answer for the first part, right? Then the project expenditure incur. You are given, you are given 1st of April 4 million, 1st of October 3 million, 1st of January 2 million. The finance the project, NHL obtain a specific loan, underline 6 million, 1st of April 2025 at the annual interest of 10%. The temporary unutilized portion of the loan generated investment income 40. You know the standard, based on the interest to be capitalized, you can deduct this 40 million. You can deduct interest, interest income generated from the investment on temporary basis. That particular interest income can be deducted from the borrowing cost to be capitalized. Otherwise, this interest income should be charged to P&L, no, as interest income. But in this case, different accounting treatment, you can deduct from the borrowing cost. In addition, the group had general borrowing outstanding throughout the year. In addition to this specific borrowing, they are using common loans, pool loans. Uh, Loan A, loan B. In this case, there are two different rates. Therefore, you should calculate uh, borrowing cost capitalization. Borrowing cost capitalization. Right. Can you please calculate borrowing cost capitalization? I will give you couple of minutes for you. Couple of minutes. Calculate the borrowing cost capitalization. Give me couple of minutes. I will return within couple of minutes. Please try to compute this borrowing cost capitalization. Right, okay. Yes, there was an answer. Mm, common rate. What is the rate? What is the rate? 9.5. That's correct. That's correct. Okay. Another thing is, as per the description, there is a suspension period. Suspension. They have not worked during that period. How many months suspended? Hmm? Suspension due to regulatory approval, delay, not construction work during that period. Therefore, you cannot capitalize that period, right? From suspension from, look at this. Construction activities were suspended from 1st of December 2025 to 31st January. 1st of December, 2 months, right? 2 months suspended. Hmm. Board has requested advice regarding capitalization of borrowing cost for the end of 31st March 2026. Right. Board has requested advice. You need to write as advisors. Okay. Then first we have mentioned, yes, this is a qualifying asset. Then you need to determine capitalization period. For this particular qualifying asset, you can capitalize 1st of April 2025 to 1st of December 2025, right? And again, you cannot capitalize from 1st of December to 31st January. You cannot capitalize due to suspension, right? Then April to November, 8 months, February to March, 2 months. Altogether, you can capitalize for 10 months for this year. Then, as you are aware, there is a specific borrowing cost. What is the loan amount that they have obtained? 6 billion. 6 billion that they have obtained as specific loan. Specific loan. Now, definitely specific loan, yes, they would be using that specific loan for the construction. Hmm. You saw the loan or the capital requirement. So this is the capital requirement. 1st of April, they would invest 4 billion. 1st of October, they invest 3 billion. Now, 4 billion, definitely they would use specific loan. Then 1st of October investment, 3 billion. Now, 4 billion gone. Then from 6 billion loan, another 2 billion remaining. Then this 3 billion consists of 2 billion from the specific loan and 1 billion from the general loan, right? Then 1st of January 2026, this entire 2 billion from general loan, not from the specific loan, right? Yes. Yes, very nice. You have answered. It's very interesting. You engage with the chat you have provided. I just mentioned, I just check the chat. There were 6 messages, then I just check. Yeah, that's interesting. Mm, yes, now I was trying to explain specific borrowing cost. The rate is 10%. That is clearly given. So what is the annual interest cost? What is the annual interest cost irrespective of the suspension period? What is the annual interest cost for 6 billion loan at 10%? That is 600 million, right? Then from that 600 million, you can take interest for the 10 months out of 12. How much? 500 million. 500 million. From that 500 million, you can deduct 40 million. 40 million is interest generated. No? Now, initially they spent only 4 billion. They obtained 6 billion. The 2 billion can be invested in temporary basis. Then they have earned 40 million interest. Then you can deduct that 40 million. Then interest to be capitalized or else borrowing cost to be capitalized from the specific loan is 460 million. 460 million. 500 minus 40, huh? Right. Okay. Nice, yes. Navodaya. Yes, very nice. Very nice. Now we'll talk about general borrowings. General borrowings, they have two loans, no? 8% and 12%. Then you can take proportionate amounts, interest, 5 billion into 8%, 3 billion into 12%, 400 million and 360 million. Total interest is 670, no? 760 million, no? Right? 760 million. Total debt amount, 8 million, no? 5 plus 3, 8, no? Then you can divide 760 million divided by 8,000 million. 8,000 million. You can convert both denominator and the numerator, the same pattern. 1 billion, one item billion, one item million. No, it does not work. It does not work. Be careful when you are calculating. 760 is the total interest. Then that should be divided by total debt 5 plus 3, 8. That means 8,000 million. So what is the answer? 9.5%. That is the capitalization rate. Right. Okay. And you know the project expenditure, 1st of April. Now you have seen, see, 1st of April, 4 billion. 1st of October, 3 billion. 1st of January, 2 billion. 2 billion. Yes. Okay, now you can provide the answer for the uh, general borrowing, sorry, the common borrowings capitalization. How much that you should capitalize. Now, this particular discussion now, if we are looking at the question paper first time and listening to the answer first time, your absorption definitely very less, because you have not read the question, you have not internalized. Internalize. Then this effectiveness is very, very less. My advice is to spend some time, read the question and write the answer. Write the answer. Then you can watch this particular video. Once you can watch then you have your own answer. Then you can mark whether you have answered correctly or not. Okay. That's why the CA Sri Lanka has conducted this examination physically. Given all the you have been given real experience in the examination. That's why we call mock examination. But I know majority not attending. Majority not attending. They just there are reasons for poor failure rate. Sorry, the poor, yes, poor passing rate. There are reasons for poor passing rate. Right. Since we are running out of time, I'm not going to take much time for advices. Right. Now we'll talk about general loan interest. Right. Now, as I mentioned, specific loan would be utilized in the beginning, meaning 1st of April 2025, now 4 billion invested, then that 4 billion should be invested from the specific borrowings. No? Then 3 billion should be invested, 3 billion has been invested on the qualifying asset on 1st of October. Now, 4 plus 3, 7. Out of 7, 6 billion from specific, 1 billion from the general. From the general. 1st of October expenditure exceeding the remaining specific borrowing. That is 1 billion. That is 1 billion. Okay. 1 billion. 1 billion. Then take the proportionate months from 1st of October. How many months? How many months remaining for this particular year? How many? Can anyone tell how many months remaining? So you have to have how many months? Are we not talking for 6 months, right? Yes, yes, we are not going to take 6 months. Now you can count 1st of October. 1st of October to 1st of January. How many months? 1st of January, how many months? No, not 1st of January, 31st March. How many months? October. Yes, 6 minus 2. Suspension 2, no? Then 4. Right. Then how about 1st of January 2026? 2 billion needed. That 2 billion also would be taken from common loan. Then what's the amount? What's the amount? You need to take the total, huh? January how many months? Until 31st January, suspension is there. Then February, March, 2 months only, 2 months. Then 2 billion divided by 12 multiplied by 2, 333. Then 333 plus 333. Then take the total. 666, the borrowing cost, multiplied by 9.5. 63.27. Did you get what's the total uh, borrowing cost? And now you have calculated 9.5. No, you have calculated 9.5, right? That's the capitalization rate. In order to apply that 9.5, you have to have the borrowing or the loan amount used, loan amount used, right? Right. Yes, 63.27, huh? 63.27, 63.27. Yes. I will provide the answer in the whiteboard for your 1 billion means 1,000 million. 4 months divided by 12, 333.3. Then again, 1st of January, they incur 2,000 million. Then until 31st March, there are 2 months, 12, right? So again, 333.3, altogether 666.6. And borrowing cost, borrowing cost, 666.6 multiplied by 9.5. There are some alternative methods as well. I will explain that one as well. 63.32. We take these decimal places. 63.32. And total capitalized borrowing cost is earlier 460, then 63.32. Total would be 523.32. Right. Okay. Yes, that's yeah, there is a nice question from Mohammed. Can the suspension period be considered as uncontrollable circumstances? If so, it would be appropriate to continue. Yes, that's a judgment, but in this case, uh, no. Now, there is a clear example. Uh, let's say when we are constructing a bridge, we know couple of months the water level would increase. But in that period, organization can do control other activities connected with the bridge construction, maybe calling quotation, something like that. But the works would be continued. Then we would not be considering that water level going up due to rain, high raining. We are aware about it, but we continue the work, related work, maybe office work. The During that period, since office work is continuing, we continue capitalization of borrowing cost, right? We are not going to suspend. But in this case, you need to read carefully. No any activity, no any activity suspended. So in that sense, better to charge that interest to the profit and loss rather than capitalizing to the respective asset. Make sense, Mohammed? Make sense, Mohammed? Right. That's matter of now in this question clearly mention no any activity, right? Therefore, you cannot capitalize during that 2 months, right? Okay. Now we'll go to next part. Mhm. Then I would be explaining another way of calculating. We can calculate now this 9.5 for the entire year. No, another way of calculating. You can try it. 9.5 is the annual rate, annual borrowing cost capitalization rate, common one. Then we can calculate the uh, total the capital amount required from 1 billion 1st of October to how many months? 6 months, no? 6 months, no? 1 billion into 1 billion into 6, sorry. Yep, 6 but divided by 12. 500, no? That's 500, right? Then 2 billion in January. January, there are 3 months, no? There are 3 months. Yeah, you can calculate the accumulated loan requirement and multiply by 9.5 and take uh, what do you call 10 out of 12. But in that case, you need to take accumulated loan balances, right? Accumulated loan balances should be taken and apply 9.5, take for the 10 months. That's also alternative method of calculating. But the method that we have used is easier for you to understand, right? Now we'll go to next one, share-based incentive scheme. Share-based incentive scheme. So read the question. On 1st of April 2025, NHL granted 2 million share options to senior executives. Key terms include exercise price 80 per share, fair value at the grant date 25 per option. Grant date. There is a vesting period of 3 years. Vesting period of 3 years. Employees must, that is the condition. So the conditions are there, no? The condition is employee must remain employed throughout the vesting period. The option vest only if the cumulative earning growth 20% over the vesting period. There is another uh, condition. The grant date, management estimated that 90% of employees would satisfy the service condition and that the performance target was probable. 31st March 2026, management revised expected employee retention rate to 85%. The earning growth target continues to be considered probable. The remuneration committee requires advice regarding measurement and recognition of for financial year 2025-2026. Right. Now we'll talk about the answer for share-based payment. Right. What is the classification? What is the classification? Can you please tell what is the classification? Now there are different types of share-based payments too. Cash settled share-based payment, equity settled share-based payment. What's the classification? Yes, of course, equity-based share-based payment. The arrangement gives employees right to acquire shares. Therefore, this is a equity settled share-based payment. You can write on that way. On the grant date, what is the fair value? Options granted 2 million, right? Options granted 2 million, right? How many? Go to question and see. 2 million share options? No, yes. What's the fair value? Fair value is 25 rupees. So what is the total grant date fair value? 2 million into 25, 50 million. 50 million. So you can write that one as well on the grant date. Vesting conditions. Vesting conditions. There are one service condition and the performance condition. Can you please tell what is the service condition? What is the performance condition? Service condition is employee must remain employed. This would be affecting the number of expected to vest. Then there is another performance condition that is 20% earning growth target. Right? This is a non-market performance condition. Therefore, this is not affecting the fair value. Right. Then year-end estimate. Year-end estimate. So they have changed the estimate to 85%, right? 2 million into 85%. That means 1.7 million options. 1.7 million options. In that case, what is the expected total expense at the year-end estimate? You can use the chat and tell. Now 2 million into 85%. Do I need to write? 2 million, that's the total number of options. 2 million into 85%, that is the percentage. 1.7 million. The total expense into 25, 42.5 million. Expense for the first year, this is total value, no? This is the total value. So expense for the first year, vesting period is 3 years, no? So 42.5 divided by 3, 14.17 million. What's the journal entry? Employee compensation expense debit. Employee compensation expense debit 14.17. Equity or else share option reserve. Equity share option reserve credit 14.17 million. So this is the journal entry. Right? In that case, expense that we should recognize for the year ending 31st March 2026 is 14.17. Right. Okay. Moving on. Moving on. Related party. LKS 24. Related party relationship and transactions. NHL's Chief Executive Officer, Mr. Arjun Pereira, is also a director and 35% shareholder of Quantum Logistics Private Limited. Quantum Logistics Private Limited. During the year, NHL purchased logistics service from Quantum Logistic amounting to 850 million. Outstanding payment balance at year end amounting to 125 million. Transactions were conducted at market rates. Transactions were conducted at market rates. Right. In addition, NHL provides corporate guarantee of 2 billion to commercial bank on behalf of Solar Future Private Limited, a company controlled by the spouse of chairperson of NHL, spouse of close family member NHL. No fee was charged for providing the guarantee. No fee. Certain directors argue that disclosure is unnecessary because all transactions were conducted on normal commercial terms and no losses have arisen. Right. Now, what they have asked on the LKS 24. Assess whether Quantum Logistics and Solar Future Limited are related parties. Evaluate the required disclosures. Discuss whether disclosure exemptions are available because transactions occurred at market terms. Right. 10 marks. First one, Quantum Logistics. What do you think? Is that related party? Is that related party? What do you think? Yes, that's a related party. The reason is CEO, director of NHL owns 35% of Quantum Logistics. Therefore, CEO exercise significant influence over Quantum Logistics. You should write those terms, significant influence. right? If you are not writing them in the answer script, you would not be given marks, right? Significant influence word should be written. It's 35% knowns, no, right? So that particular knowledge is coming from consolidation. Maybe LKS 28 the what do you call associate investment in associates, joint ventures, mm, equity method of accounting. I'm telling them for you to remind what you have learned. Huh? Right. Okay. Then quantum logistics. Okay. Then how about Solar Furniture Private Limited? Controlled by the spouse of NHL chairperson. Close family member. Close family members are included within the related party definition, right? So therefore, Solar Future is a related party. Related party. Okay. Then what to be disclosed? What to be disclosed in quantum one? There is a transaction for 850 million, and there is outstanding balance of 125 million. You need to disclose the nature of the relationship as well as nature of the transaction. Transaction detail also should be disclosed. You should disclose the transactions and the outstanding balance as well as the nature of the relationship. Okay. Right. Then there is the corporate guarantee given. You need to disclose by solar to the solar furniture spouse company. You need to disclose the 2 billion guarantee balance, even though no fee is charged. It represents a related party transaction, must be disclosed. You should write on that way, but in the exam, in the body of the information, it's clearly mentioned that has not been there is no fee. There is no fee charged, even though the fee is not charged. Since there's a related party, that should be disclosed. Right. In addition to that, discuss these whether disclosures exemptions are available. Now, for that, you can write LKS 24 requires disclosure regardless of whether transactions occur at market rates. Normal commercial terms do not remove disclosure requirements. There is no exemption. If the management claims length pricing, sufficient evidence that is required, right? In addition to that, as per case 24, you need to disclose nature of the relationship, amount of the transaction, outstanding balance, guarantees, terms and conditions. Terms and conditions. Right? Okay. Okay. We'll go to last one. E. Evaluate the management and disclosure requirements applicable to the digital infrastructure asset under SLFRS 13 fair value measurement. Identify the appropriate fair value hierarchy level. Assess the valuation approach used. Explain disclosure requirement related to significant unobservable inputs and valuation sensitivity. Advise whether commercial sensitivity justifies omissions of disclosures. 10 marks, huh? 10 marks. We'll see that one. Right. Fair value measurement of digital infrastructure assets. NHL owns a portfolio of specialized data center infrastructure assets. used in providing cloud computing services. Cloud computing services, right? 31st March 2026, the management elected to measure these assets using fair value model. Fair value model. Data centers, no? Data centers. Fair value model. A valuation specialist estimated fair value at 12.8 billion using discounted cash flow model based on forecast cash flows over 15 years. They estimated the cash flows that could be generated from this data center and take the present value of it. Take the present value of it. Hmm? Take the present value of it. Expected technological obsolescence assumptions, estimated terminal growth at 4%. Those are assumptions that they have used to estimate the cash flows and all. Discount rate is 11%. Discount rate is 11%. No active market exists for these assets and significant valuation inputs are not directly observable. Management is concerned that detailed disclosure of valuation assumptions may reveal commercially sensitive information to competitors. Competitors. Right. So those are the information given. Now we'll provide the answers for the requested questions. Fair value hierarchy. Fair value hierarchy. There are two hierarchies. Now, what are the hierarchies? Can you please tell me? The first question about the fair value hierarchy. First one, as you are aware, there are three levels. First level is quoted market price. Level 2 is observable inputs, but not like quoted market price. Level 3, significant unobservable inputs. Right? Okay, now based on you are given information, there is no active market. They have used some estimation. They have used some, discounted method used to calculate the fair value. Therefore, you can conclude that they have used level 3, unobservable data. That's level 3. Okay. So valuation technique that they have used is income approach. Income approach means, what do you mean by income approach? You need to go through the SLFRS 13. You need to go through the income, the standard. Standard explains different approaches. Market approach, income approach. Since they have used cash flows that could be generated from the asset, that's called income approach. Income approach. That is permitted under SLFRS 13. That valuation reflects future economic benefits and more importantly, time value of money is considered, as well as risk adjustments are there because cash flows are estimated by considering risks. No, therefore, this particular approach is appropriate. So, what are the disclosures required? The valuation technique is discounting method. There are significant unobservable inputs. You need to disclose discounting rate that you have used. Terminal growth, that's 4%. You should disclose. Obsolescence assumptions, forecast cash flows, you need to disclose. Then reconciliation also should be disclosed. Opening to closing level 3 balances. I hope you have seen in annual reports how these things are disclosed. So you can download real financial statement. That is an essential before facing the examination. Download couple of annual reports and see how they have done or how they have applied IFRS S1, S2, how they have disclosed. In addition to that, how they have connected to financial statements, right? At least take one annual report from industries that you predict. Maybe plantation, maybe apparel industry, hair apparel, There are a couple of apparel in the companies from different industries. No? So you can see similarities as well as differences in corporate reporting. Corporate reporting consists of three things: financial reporting, sustainability reporting. What is the other one? Can anyone tell me? Corporate reporting consists of three things. I told you two things. What is the remaining thing? Can anyone tell? Corporate reporting consists of three things. I said financial reporting, number two, sustainable reporting. What is number three? Can anyone tell? Number three, environmental. No, 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 no. Number three, what is number three? Navodaya. So very nice, huh? You are uh, always engaging, always engaging. Integrated reporting is not, no, no, that's not. Ah, yes, governance, yes. There is a telephone number. Yes. Samantika, then Kavindu. They said governance. Very nice. Yes, governance reporting. Corporate governance. There are compulsory disclosures to be made available in the corporate reporting. Corporate reporting is a broad aspect, not only financial reporting, but also sustainability reporting as well as governance reporting. Right, okay, nice. Uh, then we'll talk about the commercial sensitivity. Because there is a question on the commercial sensitivity. Management should argue disclosure could reveal strategic information. However, SLFRS 13 does not provide a general exemption to company for the commercial sensitivity, right? Required disclosures cannot be omitted solely on this basis. The entity may aggregate information where appropriate, but must still comply with the disclosure requirements. Okay? Because these are standard requirements. So uh, they cannot escape from such requirements. Okay? Are you tired by listening to my voice over 2 hours? Now 50 marks covered, 50 marks done. 50 marks done. Oh, battery is low. Right. There are another three questions to be discussed. Out of three, you need to answer two, no? Hmm. Next question on revenue recognition. SLFR is 15. Revenue recognition. Hmm. Part B on operating segments. Operating segments. Part B. Part C, writing part, revenue analytics and segmental performance. Right. Then question 3 on LK 16, property, plant and equipment. Whether the items are capitalized or not. So that's an interesting question. Do you need a break now? Yes, Jivanta is asking a break. Yes, we'll take a break. We'll take a break. Yes. Uh, then we'll discuss the answers for the balance parts. You can have your dinner now. I didn't take my dinner. You can take your dinner as well. Right. Mohammed is asking, sir, will it be mandatory consolidated question in mock paper? There were no questions related to the consolidation. How long? We'll take 10 to 15 minutes break. We'll take 15 minutes break. I would start 9:45 again. 9:45. Then we'll do until we get tired. Okay. Because I will be providing the answer scripts as well. So I have finalized the answer script. So I would be sharing as soon as possible to the CA Sri Lanka. Then they will be sharing with you all. Uh, mm, Mohammed is asking, sir, will it be mandatory consolidated question? Paper. Yes, now in the beginning I told you, no, I follow the model, sorry, the paper which prepared by mm, the committee in the sense curriculum revision committee, model paper, right? I follow the same paper, but the consolidation that's under syllabus, no? There can be. That's why I said in the beginning, there is a possibility. Now, these are mock papers. Sometimes in the real paper, completely in sense, the syllabus is huge. There are, from L cases, there are around 29 accounting standards. As IFRSs, there are 17 effective IFRSs, right? And there are IFRICs. There are six Statement of Interpretation Committee. IFRIC means International Financial Reporting Interpretation Committee. Hmm. Syllabus is huge. I told already, your responsibility is to cover the syllabus. Examiner would ask questions, not from the entire syllabus. They cannot ask from the entire syllabus, no. But randomly pick, and they would set the paper. Maybe on consolidation. Make sure you get required knowledge. Another thing is, there are study texts. I hope CA Sri Lanka issued study text for this subject. Yes, am I correct? Did you get the study text? Jivanta said yes. Did you read the study text? Yes. Please read the study text. You have to have time. In strategic level, the failure rate is comparatively high. Not only strategic level, even corporate level, the failure rate is high. Not because of your fault. Uh, the reason is you don't have enough time to study, self-study. You don't have enough time. Saturdays, Sundays, even night time. You are really, really depend on. Hmm? I hope you can understand what I'm trying to say. Please allocate some time for you to study independently. If you do that, you can realize your level before your exam, right? Allocate some fresh time. Maybe in the morning time, you can wake up maybe 4 o'clock, and fresh time you can spend uh, around 2 to 3 hours. You know, you should know how to utilize time effectively. Sometimes you might be utilizing your time to watch videos, only watch videos. That means there are five sensors in our body. Only couple of organs would be working. Eyes and the ears only, not others, right? But if you can make use of all senses, all organs, then the absorption would be higher. I try to understand my advice. Mm, you need to read, you need to highlight. Then your hands, you know, everything would be used. Mm. You need to read what you call study text. There is a big book. Entire syllabus is written. You need to read carefully. And there are questions. You need to write them independently. And then you can check the answer. But normally what our students are doing, you are checking the answer. But you are not writing the answer independently. You are checking the answer. Even the classes, you are checking. You are right. If lecturer writes something on the board, you are writing them in the board in your writing book. Then later you will read the same question and the answer, right? So there are multiple reasons for failures. Uh, you have next very few days remaining. Few days remaining. Uh, so don't worry. I'm not. Uh, you know, you need to face the exam and try to earn marks. Uh, you can do it. Exams are not difficult as such. Thing is, your commitment and the dedication. I strongly believe that you have dedicated, you committed, and you have read all related books, and you are ready for the exam. You need to improve or enhance your confidence on this, right? Confidence on this. So definitely you can write, but don't give up. Huh? Don't give up. Uh, if you have not studied at the expected level, sometimes you might get less than 50 marks, but don't give up. Plan properly and try to score your marks. Right? Right. So we'll take a small break. Huh? So I was telling many things. Now 9:35, I would come after 15 minutes. Huh? After 15 minutes, I would come. 9:50. 9:50. Right, welcome back. Shall we continue? Right, shall we continue? Are you ready? Are you okay? It seems okay, huh? No any response. All right, now they said okay. Okay, we'll now. I'm not going to take much time. Now, around now time is 10 o'clock now. We'll go through. Uh, First, we'll take question number three. That's LK 16 now. We'll go to question number three and we'll discuss. Yeah, what you need to answer? Right. Advise Anuradha PLC on the accounting treatment of the above cost under LK 16 property plant equipment. Calculate initial cost of the distribution center, the depreciation charge for the year ended 31st March 2026, the carrying amount of the assets as at 31st March 2026. 10 marks. Right. Uh, okay, we'll read the question now. Hmm. Anuradha PLC. Anuradha is a publicly listed company engaged in property development, retail operations, logistics service, and commercial property management across Sri Lanka. The board of directors is currently reviewing several accounting issues relating to property, plant and equipment, and investment properties for the year ended 31st March 2026. Anuradha commenced the construction of a regional distribution center in Kurunegala on 1st of April 2024. The project was completed and became available on 1st of January 2026. Right. The following costs were incurred. The 1st of January 2024, they have they started the construction, right? Okay. Right. Description, millions, purchase of land, construction material, direct labor, site preparation, architect and engineering, administrative overhead allocated by the head office, initial estimate of dismantling and site restoration cost, that's the present value, operating losses incurred during the trial operations, revenue generated during the testing phase, cost of goods produced during the testing phase, right? Additional information, the distribution center has an estimated useful life of 25 years, residual value 50 million. Restoration obligation remains unchanged throughout the year. Anuradha applies the cost model to all buildings. Depreciation is charged on a straight line basis. Right. Yes. Now, initial cost of the distribution center. So there are multiple cost items. Multiple cost items. We'll take one by one. Right. Okay. As per the standard LK16, there are three types of cost. No? Purchase price, directly attributable cost to bring the asset into usable condition, and third one, present value of dismantling cost. Dismantling and restoration obligation, right? Then there are multiple cost items. We'll take one by one. Purchase of land. Purchase of land. Can we capitalize? Can we capitalize purchase of land? Land is also under property plan equipment. Land is on property, right? Property. Property. Okay. Then construction material 600 years we can capitalize. How about direct labor 180 years we can capitalize. Site preparation 40 years we can capitalize. Architect and engineering fee 30 years we can capitalize. Administrative overhead, what do you think? Can you capitalize? No, you cannot. Administrative cost cannot. Restoration provision, and the dismantling, that's the present value. Yes, we can. 20 million, yes, we can. Operating losses, 12 million, we cannot capitalize. That should be charged to P&L. Then revenue from testing, what do you think? Can you capitalize? Can you capitalize in the sense now for the testing period, 15 million they incur cost, revenue generated 8. Earlier we had accounting treatment, then this net amount would be capitalized. Net amount would be capitalized. But now there is an amendment to LK16. Amount that we incur for the test run cannot be capitalized. That should be charged to P&L as an expense. Then the items we generate from the test run can be sold. No? If that can be sold, the revenue generated from that particular test run again can be charged to P&L. Again can be charged to P&L. Okay? So therefore, that 8 as well as 15 cannot be capitalized. So what's the total amount then? What's the total amount? Can anyone tell? Amount that we have. So I explain one by one. Huh? So you can capitalize 250, 600, 250 to 600, 180, 40, 30, 20. So what's the total then? 1120 for the entire 1120. So entire the data center, right? What's the depreciable amount? In the data center consists of 250 land value. Land cannot be depreciated, no? Land cannot be depreciated. So 1120 minus 250 land. So 870. From 870, there is a scrap value as well, right? There is a scrap value. What's the scrap? Scrap is 50. So you need to deduct 50. Then 820. 820 is the depreciable amount. Depreciable amount. So useful life is 25. So depreciation per annum is 32.8 million. 32.8 million. Got it? Annual depreciation is 32.8, but this asset is available for the use 1st of January 2026. So depreciation for the year ended 31st March 2026 is this 32.8 should be divided by 12 multiplied by 3. 8.2 million. 8.2 million. 8.2 million. Right? 8.2 million. Then total, now data center total value is, total cost is 1120 minus depreciation for last 3 months is 8.2. So therefore, the carrying amount as at 31st March 2026 is 1111.8. Yeah. So we can only see the mock paper that you share. Is anything you screen share with? No, no, no. I'm explaining by my voice. I'm explaining how you should take. Do I need to write them? Do I need to write? Do I need to write? I will provide the full answer script. I will provide the full answer script. I explain how you should take the answers. The total cost of the data center is 1120. This 120 consists of 250 land. Then the balance amount is 870. No, this is the building amount. The building amount. So not right. Then from 870, depreciation should be, sorry, scrap value should be deducted. No, 870 minus 50, 820. It should be divided by 25 years. Then you will get depreciation for the year. That's 32.8. But you cannot take entire year one. This asset is available 1st of January 2026. For 31st March 2026, year, only 3 months applicable. So 32.8 multiplied by 3, 12, divided by 12. So you would get 8.2. This is the depreciation for 3 months. And carrying value you can calculate for the entire asset 1120 minus 8.2. So you will get 1111.8. Okay. Now we'll talk about, is that clear? Right, that's clear, right? This is not a difficult question, but I decided to test on LK16. This is very common standard, practical standard. Mm. Even though you have learned in multiple times, sometimes there can be mistakes. Even though you learned multiple times, right? Okay. Then we'll go to LKS 40. Anuradha owns several properties in Colombo and Kandy. The following information relates to these properties during the year end 31st March 2026. Property A, Colombo Office Tower, acquired 1st of April 2023 for 900 million, held solely for earned rental income. Then definitely this is a what you call investment property as per case 40. The fair value 31st March 2025 980. Fair value 31st March 2026 1080. Property B, mixed use complex building owned by Anuradha, consists of ground floor occupied by Anuradha's rental operations, 30% of the floor area. Upper floors leased out third parties, 70% of the floor area. Right. Uh, Ground floor is the owner occupied, 70% investment property. The proportions could be sold separately under the local property laws. The carrying amount of the entire building 700 as at 31st March 2026. Then there is another property, strategic land, property C. Anuradha owns vacant land, acquired 300 million. Management has not yet determined whether the land will be developed for the future owner occupation. That means undecided. As per the definition of investment property, uh, land, uh, undetermined. The currently that is vacant, undetermined. So that's under the definition of investment property. Held for capital appreciation. That may be a person. The reason, capital appreciation, sold for ordinary course of business. Sold in the ordinary course of business. The land is currently not being used. Fair value 31st March 2026, 360 million. Additional information on the applies fair value model, all investment property. As per subsequent, initial measurement should be at cost. LK16 clearly explained. Sorry, LKS 40 clearly explained. Initial measurement should be at cost, but subsequently, there are two options, either cost model or fair value model. Fair value model, not the revaluation model. There is a difference between fair value model and the revaluation model. There is a difference. There is a difference. Right? So what's the difference? Revaluation model, we revalue the class of asset once in every 3 years or 5 years. After revaluation, we do depreciation. We do depreciation. However, another thing, if there is a revaluation gain in first time, we charge them into OCI. We record through the OCI, other comprehensive income. If there is a loss, we charge to PNL. Likewise, you know the standard LK16. It clearly explained, right, in cost model. 16 as well as LK's 40. When we are using cost model, you need to apply LK 16, the same methodology, right? Then what do you call fair value model? That's not like that. Every year end, we should get the fair value of the investment property. Then fair value changes should charge to P&L, not the OCI. Yeah? Irrespective of the gain or loss, you should charge to P&L, profit and loss, profit and loss, and no depreciation. Investment properties, if you select fair value model, no depreciation, no depreciation. Okay? Right. Investment property. Now we read, we'll see the required thing. Evaluate the accounting treatment of properties A, B, and C. Determine whether each property qualifies as investment property. Explain the appropriate accounting treatment. Calculate gains, losses. Recognize profit or loss for the end of 31st March 2026. 10 marks. Right. Okay. Anuradha can apply fair value model for the investment properties. Property A, Colombo office tower. What do you think? It is sold solely for rental income. You can apply or comply with the definition given in LKS 14 for the investment property. Yes, that's investment property. Fair values are given 31st March 2025, 26. You can see the uh, gain. What is the gain? 31st March 2025, 980, 31st March 2026, 1080. So there is a gain of 100 that should be charged to PNL. Right. Mixed use complex classification 30% own occupied, 70% rental to other parties. So 30% of the complex is uh, covered under LK 16 property, plant and equipment. 70% should be covered under LK 14 investment property. Right? Carrying amount is 700, no? 700 into 70%. That is 490 as investment property, 210 as property, plant and equipment. Okay. In this case, there is no fair value related information, so you can keep as it is. There is no change. You can keep as it is. C, strategic land classification, investment property. Y, land held for an undetermined future use is presumed to be for capital appreciation, right? Then you can see the fair value. The cost is 300, fair value 360. Then difference is 60. This 60 should be charged to PNL. Yes, PNL. PNL. Okay. Total. Then the property A gain is 100. Property C gain is 60. Total gain is 160. Right. Then part C, 5 marks. Can't see the no, I have not written anything in the whiteboard. Alf, I did not write anything on the whiteboard. I was explaining only. I was explaining only. Do I need to write them? Do I need? Alf? Because in the beginning I asked, uh, whether should I write on the whiteboard one by one? Then the majority of people who provide comments said better to discuss rather than writing. As we are providing the detailed answer script. Detailed answer script, right? Okay. You can listen carefully, then you can apply, you can check your written answer, and we are suppose that you have answered already, yeah? You have answered. So you are with the red pen now. You are with the red pen, right? You are with the red pen and you are giving marks out of 10, how much that you can earn. You can estimate that based on your judgments. Uh, Normally, there can be overstatement of marks, but don't worry. You would decide. You would decide based on the required answer scripts. The allocated marks can be estimated, right? Yes, we'll go through last part C. Hmm. The board is considering expanding its property portfolio and intends to increase the proportion of assets held for rental income and capital appreciation. Analyze how the application of LK 16 and 40 can influence the interpretation of Anuradha PLC's annual position, performance, and investment strategy by investors and lenders. Now, uh, and this is for 5 marks. Impact of LK16 when uh, they are influencing on more expanding the property plot portfolio, intends to get rental income, then as well as capital appreciation. What would happen? There can be more assets under property under LKS 40. So what is the impact? What is the impact? What is the impact? As per LK 16, more relevant, they would focus on, they are using cost model now under property plant equipment. Property plant equipment reported at costless accumulated depreciation and provides stability and reduce volatility. Then, in terms of profit and loss, annual depreciation expense reduces reflects assumption of economic benefits over time. Then in investment decisions, you can highlight operational assets used in generating revenue. So they can invest more on assets which use for revenue generation. Then we'll see the impact of LKS 40 financial position. Investment properties reported at fair value. No? Then financial position reflects the current market conditions. Then in terms of profit and loss, the fair value gains and losses recognized in the profit and loss, right? It may create earnings volatility because fluctuate, based on the market conditions, fair value of the property would volatile. Then it create earning volatility because profit would be fluctuated. No? Profit would be fluctuated. Investment strategy demonstrate management's ability to generate rental income, capital appreciation, property portfolio growth, right? Then in terms of investors and lenders perspective, users can assess quality of assets, market value of the property portfolio, future rental income portfolio, asset-backed borrowing capacity, long-term value creation, right? Okay. Now we can, now 75 marks done. 75 marks done. Shall we discuss now? What's the time? What's the time? 10:20. 10:20. We have another two questions to be discussed. There is a question from Navodaya. We'll see. We'll read the question. What? Lonto, oh, what? Interest income. Interest income for the investment property subject to income tax. But under property plant equipment, depreciation charges apply. But more than tax benefit from capital allowance. Investment income. Investment income. Now you are asking question from taxation. This is not related to this subject. Maybe you are writing tax paper as well. Low interest investment income from property subject to income tax. Yes. But under property plant equipment, depreciation charges apply, but more than benefit from capital allowances. Accounting rules and regulations and tax rules and regulations different, no? As per accounting rules and regulation, we do accounting. If we categorize depreciable assets, we do depreciation maybe on straight line basis, reducing balance basis, or production unit basis. We do depreciation based on management judgment. Useful life would be determined by them. However, tax department, tax law does not allow us to deduct depreciation. Therefore, that should be added back. Instead of that, tax department or tax law provides capital allowance. Right? Now there is an impact on the profit and loss. No, if you categorize, or if you the measure investment property and fair value model, both ways fair value changes that can be happen, either positive, either negative. If there is negative, we charge to P&L, then profit would reduce. If there is a positive figure, then profit will increase. Right? Therefore, what you need to do now, anyway, land cannot be depreciated. No, that's not applicable. But buildings, if we have given on rent, the building, no, you need to apply normal income tax law. Capital allowances can be claimed for them. But accounting different. But we need to add back that, no? Right? So there are accounting treatment as per the standards, but tax law remain unchanged. Tax law capital allowance can be received for lands, buildings. Sorry, land cannot be depreciated, no, for buildings, motor vehicles. So that is common. I hope I answered for your question. Navodaya. Hmm. But uh, hmm. Shall we look at, we'll discuss another question. Question number two. Question number two. Question number two. We'll take question number two quickly. We'll try to finish by 11 o'clock. Huh? 11ටවත් නේද නිදාගන්න? මම වැඩි වෙලා ගන්න because your valuable time, your valuable time will quickly go through. Or else what we can do is I will share the answer script. You can ask questions, the common questions. So openly we can discuss. You can switch on in the sense you can unmute your mic and ask questions. If I know, I would answer. If I don't know, I'm not going to say I know everything. No. In accounting, like a sea, very huge. There are IFRIC 6 accounting standards. But if I know the answer, I would definitely provide. Then if I don't know the answer at that time, I will search, inquire, and provide the answer. That I can give the guarantee. Right. Yeah. What do you prefer? Shall we discuss question number two? Question number two. We'll take question number two now. Standalone selling prices. This is on SLFRS 15. Revenue from contract with customers. It's very powerful standard. Very powerful. This standard replaces multiple standards like IFRIC 15, IFRIC 13, customer loyalty programs, then SIC 31, barter system, then LKAS 6, LKS 18, replace LKS 11, construction for construction contracts. So we have, because of SLFRS 15, all standards that I have listed eliminated, removed. That's why I said SLFRS 15 is very powerful standard, very inclusive standard, inclusive standard, right? Aralia PLC is a publicly listed Sri Lankan conglomerate engaged in information technology service, digital infrastructure development, renewable energy, and selected renewable energy solutions and industrial automation projects. The group operates throughout Sri Lanka and selected regional markets for the year ending 31st March 2027. Management is evaluating several financial reporting issues relating to the revenue recognition and segment reporting. Revenue contracts, SLFRS 15, Early entered into following contracts during the year ended 31st March 2027. Smart City Management System, 1st of April 2026, early entered into contract within the municipal authority to provide design and implementation and integrated smart city management platform, 5 years cloud-based monitoring and maintenance service, user training, municipal staff upon implementation. The total contract price is 300 million. Standalone selling prices are given for all specified performance of. Now there are 5 steps. No, I hope you are remember, you are aware with them. Identify the contract, identify the performance obligations, determine the transaction price, allocate the transaction price to each performance obligation based on stand-alone selling prices. The last step is, fifth step is recognize the revenue. Recognize the revenue, right? Those are the 5 steps. Remember, when you generate, when you recognize revenue, follow 5 steps. Follow 5 steps. Additional information is given. Implementation was completed 30th December 2026. User training was completed immediately after implementation. Cloud monitoring service commenced 1st of January 2027. The customer paid 120 million. So payable equal installment 31st March 2028. Earlier concludes that no significant financial component exists. Then part contract B, renewable energy software platform. 31st of July 2027, earlier entered into contract with a solar energy company to provide a perpetual license for the property energy management software, 1 year, and technical support for software updates. Contract price is 90 million. The standalone selling prices are there. Software license and technical support, those are the performance obligations that has been given. Software license was transferred to the customer 1st of July 2027. Technical support and updates are provided evenly throughout the contract period. Contract C, performance-based consideration, earlier completed industrial automation project for manufacturing customer. The contract contains fixed consideration 150, performance bonus 30. Management estimates that there is 80% of probability that performance target will achieved, and concludes are highly probable that significant reversal of revenue will be not occur. Evaluate the accounting treatment about the contract and SLFR 15 revenue from contract with customers. For the end at 31st March 2027, your answer should identify the performance obligation, determine the transaction price, allocate, explain the timing recognition, calculate the revenue to be recognized for the end at 31st March 2027. 10 marks. So I am not going to, take one by one. Quickly, I will go through, I will give the guidance on how to answer for this particular question. Now, contract A, you need to write step by step, identify the contract. You can say there is a valid contract between the customer and the smart city management system, something like that. Then identify the performance obligation for the contract A. There are 3 performance obligations basically: design and implementation of smart city platform, cloud monitoring and maintenance service, user training service. Then we can determine the price. That's the next step. 300 million. There is no significant financial component exists, right? Then you can allocate that 300 on standalone selling prices. Standalone selling prices. Total amount of standalone selling prices, how much? Seems design and implementation, they mentioned 220. Cloud service 100, training 40, so total 360. Then uh, then total transaction price can be taken as a proportionate value of 360. So 300 divided by 360 multiplied by 220, 183.33. So likewise, you can get the revenue the allocation, the transaction price allocation. Revenue recognition, design and implementation completed on 31 December 2026. Performance obligation satisfied at that point. The revenue can be recognized 183.33. Computerized completed immediately after implementation, that is training, revenue recognition 83.33. Cloud monitoring service, allocated revenue 83.33. Service period 5 years, 60 months. So service commenced on 1st of July 2027. Revenue for 2026, 2027, 3 months out of 60 months. So therefore revenue would be 83.33 divided by 60 multiplied by 3, then 4.17 million. Right. Then when it comes to in renewable energy software platform, there is a contract between those two parties. You can write it. Then performance obligation, software license and the technical support update, transaction price 90. There are two specific, standalone selling prices. Standalone selling prices, that is 81 and 27, altogether 108. So you can get the proportionate value of 90 from 108, right? 90 divided by 108 multiplied by 81. 90 divided by 108 multiplied by 27, right? So that's how you should allocate. Then software, what is the allocation? That is the allocation 67.5, right? Software license 67.5. Then the support service 22.5. Revenue recognition transferred on 1st of July 2026. You can recognize immediately. 67.5 can be recognized on that date. Support service that's recognized over time. Contract period 1st of July 2026 to 30th June 2027. 30th June 2027. 12 months period revenue for year of assessment, year ending 31st March 2027, 9 months, then 2020, 22.5 multiplied by 9 divided by 12 for the support service. 9 months, no? So 16.875 million. Right, last one. Performance-based consideration. Variable consideration, fixed consideration is 150, bonus 30, right? Bonus 30. The management estimates 80% probability of achievement. The bonus satisfies the constraint requirement because management concludes it is highly probable that no significant reversal will occur, right? So transaction price 180, right? 150 plus 30. Revenue recognition, project completed, entire performance obligation satisfied, so revenue could be recognized 180. Right. I was explaining and giving some insight on SLFRS 6, SLFRS 15. If you are tired, please let me know. Please let me know. Then we'll talk about operating segments. Oh, what happened? That's happened. I was explaining variable consideration. You know that 80% probability, 80% probability we have considered. I mentioned it. Now there is a comment, 80% probability not considered. No. We have, in that case, the performance-based consideration, contract C, fixed consideration 150, bonus 30. Management estimates 80% probability of achievement, right? The bonus satisfies the constraint requirement because management concludes it is highly probable that no significant reversal will occur. Therefore, bonus is included in the transaction price. That's why the bonus is included. So that's the justification of including 30 million. Okay? Clear? That's the justification. Entire 30 million. Yeah, that now. 13 to 80%, 24 also can be taken, but in this case, the more justification bonus satisfy the constraint requirement because management concludes it is probable that no significant reversal will occur. Because of that, we consider 80% probability, but for the calculation purpose, we took the total 30, but one can argue that 13 to 80% 24, right? That also can be taken. That also can be taken, but since bonus is satisfied, that should be paid. No probability. There is a probability. That's true. That's a probability. No, there is an uncertainty. There is an uncertainty. That's why the entire amount has been taken into transaction price. That is the justification from this side. Okay. Right. But if you want, you can justify this 24 and include it. No issue. Then the total amount or total transaction price would be that's a constraint for the variable consideration. No? That's a constraint for the variable consideration. But we justify bonus since bonus satisfy the constraint requirement because management conclude it is highly probable no significant reversal will occur. Therefore, bonus is included in the transaction price. Right? Okay, that is the justification. Okay. When it comes to SLFR is 8 operating segments. Operating segments. So we'll have a look on that. We'll have a look. Right. Now, since the time is 11 o'clock, right? 11. Now, what's the time? We'll take almost 11. What shall we do? Is this effective to continue, or because one by one, now earlier, now the people, these discussions, uh, I will explain the answers since I said the paper, so I have the logics on thinking when I was using for the setting the paper, then I could explain them. But I'm thinking whether continue after 11, whether I'm continuing or not after 11, as I'm proposing that I would be sharing the answer script with you all. Therefore, within couple of seconds, couple of minutes, I would use to go through the rest of the questions, because within 3 hours we cannot, discuss comprehensive answer within 3 hours for sure. But giving some guidance and uh, instructions for the uh, answer writing, that is the expectation of this, right? Right. When it comes to operating segments, so you can see there are different business units, uh, and there are different thresholds, no? External revenue, intersegment revenue, profit or loss, and assets. Business units, digital solutions, infrastructure service, renewable energy, industrial automation. So there is a 10% rule. There is a 10% rule. Advise management on the application of SLFR's 8 operating segments. Identify the operating segments. Determine which segments are reportable segments. Reportable segment has been defined in SLFRS 8. Explain the quantitative thresholds applied. Discuss disclosure requirement relating to major customers and segments. Right. Identify the operating segments. What do you mean by operating segments? An operating segment earned revenues, incur expenses, uh, reviewed by independently reviewed, maybe CEO, as discrete financial information. Digital solution, now they have different segments. Digital solutions, infrastructure service, renewable energy, and industrial automation. Okay. Corporate center is not an operating segment because it does not generate revenue. You should emphasize that. There is a center called corporate center. Since it does not generate revenue, that's not an, see, corporate center, no revenue. Therefore, that's not an operating segment. You can write it. And determine the reportable segments. Reportable segments. There is a revenue test of 10%. Total revenue, uh, digital solutions 3,200, infrastructure 2,250, renewable energy 1,200, 1,100 plus 200, 1,200, no? Industrial automation 850. So total 7,500. Threshold is 10%. So 750 is the threshold. So all four segments exceed 750 million. Therefore, all satisfy revenue test. Then we'll see the profit test. Profitable segments. Profitable segments. 550, 300, 140, and 90. Altogether 1080 million. 10% threshold, 1080 into 10%, 108 million. 108. All except one pass the profit test. Digital solutions, okay. Infrastructure service, okay. Renewable energy, okay. However, industrial automation is having the profit of 90, but the threshold is 108. Therefore, industrial automation does not pass the profit test. Then asset test. Asset total, how much? How much? 3,200, 2,400, 1,400, 1,000 plus 2,000. Even corporate center, they have the assets, the 10,000. Then threshold is 10%. Then the amount is 1,000. 10,000 into 10%, 1,000. So on that basis, asset test, digital solution pass, infrastructure service pass, renewable energy pass, industrial automation pass. All above 1,000. Right. Then in terms of the calculation and the items that we have discussed, the reportable segments, since each satisfy at least one quantitative threshold, digital solutions, infrastructure service, renewable energy, industrial automation are reportable segments. There is another test, 75% external revenue test, 75% of external revenue test. Then what's the total external revenue? 3,000, 2,100, 1,100 and 800. So 7,000 is the total. 7,000 is the total. 7,000 is the total. Right? Then coverage is 100%. Requirement is satisfied. Requirement is satisfied. At least the external revenue, the 75% of external revenue should be covered for the reporting segments. Now, in this case, 100% covered. 7,000. Right. So, major customer disclosures, revenue from one customer. XLFRS 8 requires disclosures of existing of major customers, amount of revenue segment generating the revenue. Then each segment, they should disclose revenue from external customers, profit or loss segmental asset, basis of measurement, reconciliation to financial statements. Right. The part C, yes, so do we need to take corporate? Yes, that's available asset for that center. No, maybe that's a service center, but it has 2,000 asset. So for the asset test, we should take that 2,000 asset as well. Total asset is 10,000. On that 10%, 1,000. Then we should compare 1,000 for the asset test. I hope you are clear with that explanation, Madhu. Okay. Revenue analytics, right? Okay. Right. Balance part, okay. Yes, with that, once I provide those are theoretical, therefore you can see that. You can see the answer once I share. Right. Now we'll go to last one. So the question number 4. Question number 4, I set on financial instruments. Financial instruments. Right. I will brief financial instruments quickly. Then I hope you have answered for this one. Maybe physically you have written the answer script, right? You have the answer script with you. I got to know that around 30 people answered physically. Right. Here, what you need to do is now look at the question. There are multiple investments. Determine appropriate classification of measurement basis and measurement basis. Calculate year-end carrying amounts. Calculate any expected credit losses and fair value adjustments required as at 31st March 2026. Right. Advise ESLI PLC on accounting treatment of the above financial assets under SLFRS 9 financial instruments. Right. You can read this one leisurely. Financial asset as per SLFR is 32. The first standard is LK is 32, financial instruments presentation. It defines financial assets, financial liability, and financial equity. It defined, right? Then SLFR is 9 explain the classification. There are 3 classification: amortized cost, fair value through OCI, fair value through P&L. Right? Then there are a couple of what do you call investments given. ESLI PLC is a publicly listed diversified group operating in manufacturing, logistics, retail distribution, and renewable energy sector across Sri Lanka. The audit committee is reviewing several accounting matters relating to the financial instruments and employee benefits for the end of 31st March 2026. ESLI holds following financial assets 31st March 2026. 1st of April 2025, investment is government treasury bonds. Easily purchased government treasury bonds, 200 million. The additional information is given. Bonds pay fixed annual interest of 10%. Bond mature 31st March 2030. Management intends to hold the bonds to collect contractual cash flows. The fair value of the bond 31st March 2026, 190. The expected credit loss 31st March 2026 was 2 million. Right. The listed equity shares 31st July 2025 initially acquired listed shares of a technology company 120 million. Additional information: investment is held long-term strategy purpose. Acquisition easily irrecoverable. Elected to present subsequent fair value changes, other comprehensive income. The fair value of the investment 31st March 2026 was 145. The dividends received during the year amounting to 4 million. Yes. Investment B, okay. Then trade receivables. Trade receivables 31st March 2026 amounted to 500 million. Credit manager estimated current gross receivable values are given, 350, 100. That's an aging. Expected credit loss also given in respective buckets, right? Advice PLC on accounting treatment, right? First, I would, the classification. First, you should see whether you can classify under amortized cost based on the business model and contractual cash flow characteristics. Those are the two conditions that you should be aware to classify financial asset into three, right? Investment, a government treasury bond, right? There are two criteria. Business model should be invest and hold, right? Invest and hold. That's the business model. Then there should be contractual cash flow characteristics, meaning there should be interest and the capital outstanding, right? The bond generate solely payment of principal and interest. So SP, that particular test is satisfied and held to collect contractual cash flows. So therefore, both requirements satisfied. Therefore, amortized cost. Amortized cost. Okay. Since there is a expected credit loss allowance also should be accounted. Impairment loss 2 million and credit loss provision is 2 million. Right. Then next investment is B. Investment B, listed equity shares. What would be the classification? Fair value through OCI. Fair value changes should charge to OCI. Right. Since there is a dividend receipt, 4 million also should be recognized to P&L. Trade receivable. What do you think? Trade receivable. Remember, trade receivable is categorized under amortized cost. Amortized. There is a specified amount, loan, outstanding balance, then mm, there is a specific time period that they are expecting to collect. So therefore, trade receivables can be classified as amortized cost. You should apply simplified approach for the impairment. Simplified approach for the impairment, right? Then go to next one. Right. That particular question is set from LKS 32. 1st of April 2025, easily issued 100,000 redeemable preference shares. 100 per share. Dividend, mandatory redemption. Holders have no voting rights. Dividend must be paid annually regardless of the profit. In addition, 1st of January, easily issued 500,000 ordinary shares warrants. Warrants allow holders to purchase ordinary shares at the fixed exercise price of 50 per share within 3 years. The board is uncertain whether these instruments should be classified as equity or liability. That explanation is given under LKS 32, whether that's a liability or equity. Right. Redeemable preference shares. So we need to evaluate the substance of the contract and the definitions, right? Redeemable preference shares more towards financial liability, more towards financial liability. Then ordinary share warrants, that's more towards equity instrument. equity instruments, right? Okay. Since we are running out of time, I'm, giving summarized answer. Uh, then Italy operates defined benefit gratuity plan for its employees. The current service cost, then interest cost obligation. I hope you are aware how to measure, how to report, particularly on gratuity. Gratuity. This is defined benefit obligation. Defined benefit obligation as per case 90. 5 marks question I allocated to cover maximum accounting standards. Right. Okay. These are some action verbs. So interpretations are there. Right. Okay. So I touched upon almost all questions in the question paper. Right. Uh, yes. Now time is all at the 11 o'clock past 6. Yes, thank you very much. The students who are, engaging with the discussion. So I know, so I covered two speed, two speed. I explained the required items. Uh, I hope you remind what you have studied during last couple of months. Right, I take this opportunity to thank CA Sri Lanka